Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us and Merry Christmas to those of you who just tuned in. We're looking at portfolios we designed on this show 4.5 years ago, which we've been tracking on a regular basis. This portfolio is our income growth portfolio. It was designed for someone who's already retired. The assumption here is that you're going to take advantage of the Senior Citizen Savings Scheme and use the remaining money to beat inflation through this portfolio. It's given us a return of nearly 9% in 4.5 years. These are the funds we have in it: the Franklin India Dynamic P ratio, HDFC MIP, Reliance MIP and UTI Balanced. Dhirendra, has this managed to beat inflation? Is this the portfolio you had intended to design when you started off?
The MIPs, they do concern me on account of their charges, but the performance is not derived from the balanced fund. If you look at what we have done is we have kept a very limited withdrawal rate. Investment of rupees 10 lakh rupees split over four funds, which is 2.5 lakh rupees each, and withdrawing only 2% on a quarterly basis, which effectively means 8%, not compound interest, but 8% withdrawal rate on a quarterly basis. In this kind of situation, when one is consuming money, still one is able to derive a nearly 9% return is quite impressive. But we run the risk of eating a part of our capital and not being able to beat inflation if the market continues the way it has been for the last 5 years.
Well, Dhirendra, for someone who's retired or near close to retirement, would you rather than they use our stable growth portfolio instead of either the income or the conservative portfolio?
No, because if you're looking at a supplementary income from your portfolio, of course this is a portfolio which should not be the part of your defined income. If you have your retirement accumulation and if you depend on such investment for regular income, this is not the kind of portfolio you should have. That money should be into guaranteed fixed income portfolio, at least a good part of it. And this I would say that is a supplementary income portfolio that you need some money periodically for to supplement your income beyond your monthly income. This can serve the purpose. I don't think our stable growth portfolio or a growth portfolio should be that is not assumed as something from which you will derive income.
All right, our income growth portfolio is on your screen right now. I'm going to give you a recap of the funds we have in it: the FT India Dynamic PE ratio, the HDFC MIP Long Term and the Reliance MIP, along with UTI Balanced, which is the only balanced fund in this portfolio. The idea behind this portfolio was for someone who's retired to put most of their money into the Senior Citizen Savings Scheme and then use this portfolio to beat inflation and to give them a regular income of about once a quarter. Let's move on to our last portfolio, and this is our low-cost portfolio. It was designed in 2010. The idea behind this portfolio is to use funds that have very low charges. The cost on the average in this portfolio is 0.85%. It's given us a total return of nearly 6%. I'm going to give you the funds in this portfolio: the Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. Those are the two funds we've used. Dhirendra, has this actually proven your hypothesis that lower cost means higher returns?
No, not at all. In fact, lower cost and lower return. And this is disappointing in the sense that, if you look at Nifty, and that is 70% of this portfolio, and Nifty has been among the best performing funds, so to say, because large caps have ruled over the last 1 year. So it should have done well, much better than what it has done. But not to say that, this is also an accumulation portfolio. So one is doing a SIP of 10,000 rupee in these two funds, 70% into Nifty and 30% into Junior Nifty. Lower cost is not translating into something meaningful right now, but I think it is too early a period to evaluate in terms of cost and benefit. I think it's a matter of, on one front, I'm extremely comfortable that it certainly is lower cost. It is not a compromise on diversification. Once money is spread over about 100 stocks by investing in these two funds, you are not into unknown names. So these 100 stocks are something which will be where you are unlikely to face the kind of consequences you do when you invest in a small cap fund or a micro cap fund or a incompetent fund manager who spreads your money across something which you don't know. So it is a proven portfolio. Yes, the cost and benefit are not visible right now.
All right, the cost and benefits are not visible right now, but we're going to continue investing in this portfolio to see what a difference it makes in the long term. to pick funds that are low cost. These are the two funds we have in our portfolio, the Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. Those two funds make up this portfolio. That brings us to the end of this show. Dhirendra, thank you so much for joining us. And of course, we're going to continue to take a look at these portfolios right through the next few years. And if you have any questions about anything you heard on the show, write to us. Our email ID is at the bottom of your screen. Tune in next week to catch the very exciting year-end New Year special, where we'll actually pick out the best funds to invest in for the coming year. So whether it's large cap, it's multi-cap, balanced or debt, we'll give you a list of funds that you can start working with in the new year. Tune in next week to catch that show. Thanks for watching.